you're an executive at, Polymarket or Kalshi, call me up. We can talk about it. Parametric insurance, right? Why aren't these guys building in this space? Because that is a highly illiquid, opaque, and I would say unsubstantial marketplace that doesn't live on chain, doesn't have smart financial quants trying to solve the problem through DeFi, and is more or less trafficked by a bunch of parasitic brokers and large balance sheet players.
Hey everyone, welcome to Bits and Bips, where we explore how crypto and macro collide 1 basis point at a time, or I guess today tens of basis points at a time. We're here to discuss the latest stories in the worlds of crypto and macro. As a reminder, before we dive in, Bits and Bips has its own channels now. If you're listening on the Unchained feed, come subscribe to Bits and Bips directly so you don't miss an episode. And before we begin, a word from one of our sponsors.
This episode is brought to you by 1inch Aqua, the shared liquidity layer from 1inch. Back multiple liquidity positions with one wallet balance, and keep your tokens in your wallet until a swap fills. See how it works at 1inch.com/aqua. Not listening to Bits and Bips yet? It's our weekly crypto and macro market show with Ahluwalia, Austin Campbell, and Chris Perkins. Search Bits and Bips and subscribe.
All right, everybody, quick market snapshot because we're going to be talking markets today. Bitcoin touched 80K, currently is hovering in the high 7,800s as I'm looking at my screen here, extending last week's run. Spot Bitcoin ETFs flipped hard into inflows. We've seen billions of dollars in across the entire week, over 500 million Wednesday and Thursday, and over 300 mil on Friday from the numbers I have in front of me. The 30-year Treasury yield remains elevated in the 5.2s, highest basically since 2007. 10 years not much lower at 4.65. So where we are with all of that is Bitcoin is now only 37% below its all-time high. For today, as always, I'm your host, Austin Campbell, High Scholar of Zero Knowledge Group. I'm here with my two usual co-hosts, Ahluwalia, Maester of Wealth, the leader of Lumina, and Chris Perkins, the golden hand of Franklin Crypto. But today, I am particularly excited because we have Gordon Grant with us, portfolio manager, head of derivatives at Bitwise. So to lay everything out before we start talking markets, everybody remember, we've got Bitwise on here, we've got Franklin on here, and I used to run stablecoins at Paxos. So all of us have views. Let's start with some framing, and then I want to talk markets, guys. So the tape last week turned pretty hard. Bitcoin topped 75K and kept running over the weekend and into today. As we said, the ETF flows flipped. And the catalyst appears to have been the Treasury. They started doing long end buybacks, talking 30-year sector with maybe some in the 10 to 20 year. They were looking at 2 billion up to 4 billion, maybe more as of today, and 30-year yields ran up. 4 billion is limited relief in a 32 trillion market, but there are some people who are saying this is positive. So Arthur Hayes on Laura's Unchained interview said, I think this is the beginning of a major move on Treasury buyback change. Warsh and Bessent are, quote, running the Powell and Yellen playbook, keep the short end cheap so the Treasury can issue short and buy back long, a sort of Operation Twist. Quote, they are going to start printing money, and the buyback is meant to scare the market into believing 5% on the long bond is the level we'll defend it at. ETH cleared 3,000 on that, but other analysts have stressed the buyback is not QE. The Fed did not turn on the printer, and that the bond market moved first, and it was a short squeeze that did the rest. So I want to start before we get into some of the other commentary, since we have a few people here who know a little bit about these markets. And Gordon, I'll go to you first. When you're looking at what Bessent is doing and what it's doing to perceptions and volatility in the market, what are you seeing here?
I feel like Bitcoin was kind of the last of the large cap liquid assets, ex crypto, to pick up on the volatility bug that's been percolating, permeating, pervading the macro space for the last several months. We had chips and GPUs and data center players and large cap fintech, and then the energy markets earlier in the year, and rates themselves. And I think what Bessent has done from my perspective, right, sitting here and trying to run a number of significantly sized Bitcoin and crypto volatility books, is make a connection between TradFi rates volatility and now crypto volatility in a way that is meaningful to institutional participants and that a narrative can be built around. And I think the market reaction is really saying not much more than that, which is to say, as you pointed out, Austin, volumes are not so significant from this perhaps redux of Operation Twist in the context of the size of the market, but signals can be as effective as sizes. I think we saw this a little bit with the way MicroStrategy's own policy articulation played out earlier in the year. When signaling wasn't effective, it took some size to finally get things moving. Here, it's a bit of the opposite. And the expectations around what it could mean if there's a steep yield curve and exactly the type of behavior that you meant, people hear, think, see, and project in terms of price and their participation burr, even if the liquidity is not yet hitting the system. And probably from a delta or second order perspective, it matters more because most folks who are watching might have started to sense palpably that the tide was going out on liquidity. And this matters, right, in some substantive way.
Ram, I want to flip over to you as somebody who's been following markets for a while here. What are you making of the price action over the last week?
Well, it's extraordinary. There's a lot happening. Number one is after Bessent had the intervention into the end market, that set commodities racing again. And if you look at the SPY versus gold chart, for example, commodities just outrunning. So that's called the debasement trade. And then you had Trump's comments around crypto, which has sparked an incredible short squeeze in Bitcoin. And you have the Treasury Secretary talking about Hyperliquid. It's like we're in a parallel universe. I mean, it's as strategic apparently as like Taiwan Semiconductor. Still continue to think like that is the asset of this cycle. It's got all sorts of interesting, properties around it. We talked about this a few months ago. The Circle and Coinbase deal with them. Bitcoin's a momentum asset. It does have momentum now, and unlike other assets, momentum assets just kind of tend to keep going. So when they have momentum, you don't want to like fade that. It is at a very interesting juncture right now, and you really have to manage this like day to day. Is how I would look at it. There seems to be a bit of waning momentum around there, but you don't have any red bars yet. So, I think there's like a tactical view and then a strategic view. I can't even think that Hyperliquid's like the better asset in the category. Trump also has midterm elections coming up. He doesn't want investigations from the House. And who got him elected? Fair Shake PAC. So the timing around this intervention plays to the political cycle as well. Clarity Act has been challenging. This is a way to deliver a win and potentially juice up those coffers to set up for the next midterm fight.
Yeah, I was going to say, do you guys see the Bitcoin gold chart? It's been pretty much vertical, which is really, I think is a good story for Bitcoin. And just to unpack some of the stuff you guys said, we've been talking on the show for a long time about the new Treasury Fed Accord, right? And I think you're going to see more of this in action this week as Warsh ends up in Jackson Hole. Probably not going to say a ton because he told people he's not going to say a ton. But what are you seeing? You're seeing these two guys working in very close coordination. And what have we known since the beginning? It's that Bitcoin, it's that crypto. It's very, very responsive to liquidity. It's very, very responsive to rates. I think people are starting to see that Warsh may say some things. Maybe he'll be hawkish, but I know I just don't see him moving rates anytime soon. He was not put in the seat if the president thought he was going to raise rates in any way, shape, or form. And you're seeing a lot of the yield curve, I guess I don't want to say control, but action being a function of Bessent. Is this the beginning of a new regime? Well, it's pretty clear to us that Bessent himself is very focused on keeping rates in check. He talks often about the 10-year. Maybe this time he went out a little further on the curve. This also plays very nicely into the stablecoin story if we can get stablecoins going, because if we can move debt to the front end of the curve, short-term treasury bills, we can issue more stablecoins. We can have people consume those stablecoins. Yields will stay nice and tight. And that's good if you're running a government and you want to keep your interest rates in check. You don't want to pay all that interest, So I think that's generally positive.
So I think an interesting dynamic that's emerging there, Chris, to piggyback on your comments, is if we look at the setup, we have Bessent talking about buying back the long end and issuing at the short end. We still have above target inflation for the Federal Reserve, but we also have significant amounts of outstanding current Treasury debt. It puts us, if you really zoom out and think about government finances in the simplistic way possible, which is to say dollars in, dollars out, a very funny situation where I might say fiscal dominance, that is to say the spending of Congress and the outstanding debt load, means raising rates also strangely shoots more money out of the fire hose. If you are quickly reinvesting all of this in short-term debt, there's more money going from the government into the private sector. So one of the things that I've been keeping an eye on here, and Gordon, I actually want to flip this back over to you for your opinion, is the increasingly divergent behavior between the front end and the long end of the curve, right? Like we see this behavior in EM historically, where the government starts doing things and kind of regardless of what they do, people lose confidence and the long end just starts going up and up and up. And we're seeing a little bit of that in the United States, and that also tends to beget vol. So what are you making of this whole situation through that lens?
Yep, bingo. In a classical economics course, you talk a lot about liquidity preference. I liken this to excess variance causing a buyer's strike, and that's really the problem here. There's actually nothing in common between 30-year rates and the front end, just as there's very little in common between 1 month implied vol and 1 year implied vol. Sometimes they're the same level, and sometimes they're different by many factors or even orders of magnitude, depending on the asset class. That excess variance has now caused liquidity to worsen, right? It's not the same as it was when rates were a lot lower. I think it's also therefore caused a knock-on effect in disparities based on what I read. Again, I'm not in the Treasury market all day, every day, like I was when I was at a macro shop for a long time. But the on-the-run, off-the-run stuff appears to be rearing its head again. It's also showing up, as it seems, a little bit in some of the swap spreads. And all of that is kind of signs of bad cholesterol, as my former mentor and boss at NWI used to call it. And I think, an Operation Twist, a jawboning policy articulation out of the Fed might be, kind of intended to bring down some of that LDL, or at least change people's perceptions and say, is this really LDL? Or maybe, there's something going on here. There's a little bit more HDL in that mix than you think, and you shouldn't be as scared of it. Now, are they going to get, and this is going to open Pandora's box for our call, so forgive me if I'm doing that, but I think, are they ever going to be able to get the international community, not ever's a long time, but in the near future, are they going to be able to convince the international community to get back into the long end in a big way, right? What would it take to convince some of the most significant international participants in the Treasury market to say, hey, take that bet on U.S. policy orthodoxy, U.S. rhetoric consistency, U.S. decision-making hierarchy in a way that would inspire, people to come back into the long end in a big, big way. Not sure that's the case, but I think it's kind of a low, it's like a low credit quality perception that we're going to have to deal with here. Of course, there is no credit quality because they can always pay back in their own currency. But I think, the credit quality for them is the variance, right? And it is something that you tend to see in sort of junk issuers and high yield, where even at higher levels of yield, there's higher levels of yield and price variance. And that's kind of making the Treasury market seasick. And there are some markets that thrive on vol, right? Bitcoin people tend to like when the vol picks up, right? When the vol is low, it's not good for Bitcoin, right? That takes us to DEC 22, Jan 23, when front-end Bitcoin vol is in the teens and 20s, when price at that time was in the teens and 20s, takes us to where we were until August 19th at about 9:30 in the morning, right? Where Bitcoin is hanging around its bottom decile of price and bottom decile of vol. High vol in Bitcoin gets people excited about it because it starts to inflate the right tail of distribution. And rates, it kind of works the other way. Rates are bounded at zero, they're unbounded to the top side. And so this kind of vol starts pricing in not just greater gyrations around some mean reverting tendency, but the skewness of the distribution. You go, hey, the log normal adjusted probability of 30-year rates going back to 4 is now going to be more equivalent to like 30-year rates, or let's say 20-year rates 10 years forward, hitting 6, 7, 8. And that starts to scare people. So you've got that skew moving the wrong way, and you've got that critotic premium in the tails of the distribution moving the wrong way. And it's interesting to see how that's being detrimental for Treasury market stability, but it's actually creating momentum behind Bitcoin. And for those of you that play in longer dated volatility in Bitcoin, we've been of the view for a little bit of time that the long end was just inappropriately priced, where you had stuff like 1 year almost sub 10 delta strikes at, take your pick, 40, 42, 43 vol. And that started to move the other way. So at the money vol is now higher, and the out of the money options vol is higher. And that's exactly what's happening in treasuries, just in the opposite way.
Hey, Gordon, the other thing I would add is in our space, the crypto space, when that volatility results in basis, where you have the future price is higher than the spot price, all the big boys want to come in, because when that gets attractive, crypto has been proven to be a very lucrative place to play the basis trade. Basis trade is very, very good for spot assets, because what you do is you buy the spot, you sell the future. When you have more buyers than sellers, what happens? Price goes up. So that's another thing to really watch, is watch basis. And that is very, very healthy for our markets.
Big time. And been a long time coming, right? For us to get
been
back.
A long time. It's been awful, right?
Yeah.
And there's no basis trade, like no reason to buy spot, sell future. And like this was a big trade during the last cycle. And I think it was one of the things that drove assets pretty high.
So to pile in here on what's going on in treasury markets, there's a weird little corner pocket of the treasury market most people don't think about too often, called TIPS, which is the inflation protected treasury market. We're starting to see some weird and chonky things moving around in the TIPS market, which is also usually a good sign something is like getting creaky in there, right? Like you're seeing very bizarre stuff like a 1 year, 2 year, 3 year butterfly action, which means the twos are much shallower than the ones and threes. You're seeing like bizarre steepeners. Real yields has been hitting some highs since the crisis. Like all of these are basically signs to me that people are starting to think the end game of some of the US fiscal imbalances may be closer than people think. Because if you look at the timing framework, we're probably now 5 to 6-ish years off to having to do something about Social Security, right? Like either just straight up cut benefits or start modifying programs or change behavior or just straight up print money. And when you're already going into that with a debt to GDP of 100 plus, you typically end up in one of two places historically. One of those is inflation, where what happens is they'll hold rates down below what essentially real inflation is to work your way out of this over a, however long period, call it a decade or two. And for those who think that haven't happened before in the United States, look at the post-war aftermath in the 40s, 50s, and then look at the 70s. Like we've done this repeatedly. The other one is default. But again, the US is denominated in dollars, controls all its debt in dollars. The dollar is used globally. Here, I think inflation is the much easier political choice. So I don't really see people going with default in this case. And that leads, I think, Ram, all the way back to you, which is to say, you're talking about Bitcoin as a momentum trade here. And by the way, I do agree there's definitely momentum in crypto markets, because while the fundamentals have definitely improved for something like Bitcoin here, it's hard to look at like Cardano rallying in sympathy a significant amount and be like, Cardano has tens of users. I'm not seeing people piling in and like more builders there.
Yeah.
This is just a momentum trade. And so there's going to be some breaks and mean reversion within the category. But where I wanted to get to is this momentum, or put differently, when everything is rallying like this, is it just inflation?
Well, let me pull back your point on treasuries. You're actually channeling Ray Dalio there. It's interesting analysis. I don't think you're going to see the end bond vigilantes breaking the U.S. Treasury market. It's the most liquid market in the world. It's the least dirty shirt in the laundry basket. The productivity growth is here. The earnings growth is here. Nominal GDP growth of the United States resembles like China a few years ago, meaning like we're the Asian tiger now. So I wouldn't get overly concerned about rates. I've noticed that in the equity markets, rate sensitive names aren't going down anymore. In fact, I don't think Bessent even needed to intervene. Markets were settling of their own accord. His intervention might have actually spooked investors. So I wouldn't. How I see this playing out is if rates go to 5% on the 10-year, that's the top in rates, and you buy whatever you can. That might be the time to buy bonds for somebody out there, not me, but somebody. I could get behind that logic. But if that happened, risk assets would be very cheap. And I wouldn't be surprised if in 6 to 9, 12 months, the 10 is lower than 4.79 because you are seeing disinflation. You are seeing productivity growth. So, yeah, I think this is much ado about nothing. You also have this August season. It seems like policymakers always like to scare markets. August, dump all the bad news here. They do the interventions here. Moody's does something around now also. So, that's some of this. On on Bitcoin momentum, it's funny. The 4-year cycle is in a way starting a little bit too early. So I don't think this. A lot of people are off sides on this as well. And Bitcoin didn't deliver what it should have this past cycle. That's just a fact, right? Versus where you were 4 years ago versus the prior cycle high. So I think the dynamics that play out in crypto are going to be very different. Again, it does have significant competing narratives against it, including physical AI. Everywhere you look, you got a robot outrunning Usain Bolt. Now you got Travis Kalanick building physical robots to do mining, to do cloud kitchens, to do autonomous vehicles. So I still think a lot of attention and capital will be more focused in those areas.
Gordon, what do you make of the Dalio parallel there? I knew Rom might drop that one. I'm curious as to your thoughts.
I'm gonna kind of pull out the EM playbook to which you alluded, and I think is apropos here. And I'll be the devil's advocate. How likely could it be that U.S. inflation index product could start to get looked at, such as something like Brazil's NTN-B market? For those of you that have played in that space, I remember it being 2011, 12 era going into the taper tantrum. I was at NWI. We had one of the world's biggest asset managers come to us and go, what's wrong with the inflation-linked product in Brazil, Mexico, South Africa, you name it? Is there an opportunity here for alpha? We debated it, and they created $100 million SMA to go out and do currency light hedged investments into inflation index product in all of those jurisdictions. It took a minute for that to kind of come right round. NTNBs have crazy duration. You can get it even longer than the flavors in North America and G10 markets. But eventually it did, because they went through a period of significant belt tightening, monetary tightening, other forms of austerity, and they left behind some of the vicissitudes of policy heterodoxy, fiscal heterodoxy. That's not unlike what we're seeing here, right? Where although productivity a big driver, although rates up at this level in the long end, starting to impose some degree of tightening of financial conditions, along with energy markets. And by energy markets, what we really talk about are the product markets. Total's CEO out there today talking about the bifurcated physical crude and physical products markets, not unlike the front end and the long end of the bond curve, right? These don't appear to exist in the same zip code, maybe not even the same continent anymore. But I do see Ram's POV there, which is to say, 5% tens. It's either this thing comes back down or we're all going to hell in a handbasket, right? Because it just can't absorb that. And that should be the top of real yields, the top of nominal yields, minus, plus or minus some variance buffer.
Yeah. And I look at this through the lens of, if we're at 5% in the 10-year, either as you said, rates are going way up to start handling this, or they're coming back down and we're going to financially repress people in some way. And you'd want to be owning the inflation products, or you want to be owning gold and Bitcoin in those cases, because you are either, what's the right way to say this, playing the game as aggressively as possible, or you don't want to be playing that game at all. And those are kind of the two vectors. It's not staying at 5. Like if something else, just be long vol at that point, around that point in sort of the surface. But I think what was most interesting to me watching Bessent and then the market reaction is right now, I'm not sure we could tell from the market signals which way people are predicting things will go, because this is probably a net improvement in either of those like outcomes right now. But where are we going to be 3 months from now, 6 months from now, a year from now? Like there's some iterativeness to this game. And I wonder how much people understand that.
Path dependency, in full force. And you raise a great point about optionality. Probably worthwhile to dust off your Bloomberg. I need to do it myself and check out where the forward curve is, right? Where's the 10-year, 10-year, 20-year, 20-year? The old playbook, the macro playbook comes out at the money spot, at the money forward, receiver spreads, things of that nature. Could be interesting. Not a recommendation to make an investment or withhold from taking action, but I'm curious to know what are the payoff, ratios for those types of strategies at this level of rates, especially in forward space.
Yeah, and I think we've seen some movement recently, like front end, back end, and breaks in the inflation market, for instance. It's all those little granular bond things are coming back and mattering now that the whole curve is not laying flat close to zero. So, all right, before we get any further into the bond market, because we're going to lose everybody if Gordon and I keep talking about that, we are going to go ahead and take a quick commercial break.
$540 million. That's how much concentrated liquidity sat idle in a given week in the first half of this year. About 30% of the DeFi TVL, if you're wondering. That's according to Dune research commissioned by 1inch. But there's a solution. 1inch Aqua is the new shared liquidity platform. It lets LPs back multiple positions with the same token balance and keep their tokens in their wallet till a swap comes. Why does that help? Because the LPs don't have to split their tokens across positions. They can cover more market conditions and pairs with their full balance. That means more activity across deeper liquidity. See how it works at oneinch.com/aqua. Remember that providing liquidity carries risk and fees aren't guaranteed. Heads up everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again.
All right, everybody, welcome back. Now we're here to talk about people fighting. And specifically, we're going to talk about the CFTC. So at the CFTC's inaugural Innovation Advisory Committee meeting in DC on August 21st, CME Chairman Terry Duffy and Kalshi's co-founder, Luana Lopes Lara, traded, shall we say, insults over prediction market oversight. Duffy was saying, quote, "We're not a bunch of carnival barkers at a circus," and warned some event contracts are open to manipulation. He said, again, quote, "I have more people in my regulatory department than you have in your entire company," to which Kalshi's CEO responded, "Maybe you should learn a little bit about efficiency then." And Duffy said, "Maybe you should learn about credible markets." Now, before we get into the brawl between them, let's also talk about Mike Selig and his comments here, chair of the CFTC. Congress gave the CFTC exclusive authority to regulate prediction markets, he said, and that the agency will defend its jurisdiction against states seeking to nullify federal law. He said, "We've crossed the Rubicon and are standing at a new frontier in finance," and framed the prior era as, quote, "anti-crypto armies, doomers, and deceleracionists." So this is a hell of a brawl. Chris, I want to start with this one for you, since I know you're like a derivatives markets guy as well. What do you make of the sparring between the CFTC and Kalshi? Do you think each argument has validity? Is somebody solely talking their book? Like, how are you internalizing that one?
I mean, I'm actually thrilled to see this dialogue happening because, like, I mean, I was in this market for so many years, and like after the global financial crisis, any kind of creativity, like any type of innovation, kind of died. Like in derivatives markets, there was nothing. Like the biggest innovation was like the regulated businesses that we built, which is like not really that innovative. We do stuff around the edges. Finally, after years, we finally have these two new innovations coming out at the same time. They've been around for a little while, but now you're finally seeing product market fit. And guess what? This is another, we always talk about convergence. We're seeing more and more the crypto market is exporting stuff into traditional markets, whether it's 24/7 markets, whether it's perpetuals. And notice I didn't say futures or swaps, kind of think they're futures. And also prediction markets. Like these are things that have really been a part and parcel to crypto markets where they had product market fit. I am thrilled. I'm thrilled that we're seeing this innovation. I'm thrilled that we're starting to see this innovation happening onshore, which again, sadly, all this innovation happened offshore because people were scared. I mean, I had portfolio companies that were literally put out of business when they tried to build onshore because again, the technology didn't reconcile with with what we have. And so we talked about market moves earlier. We said macro caused a lot of it. We also saw the presidents say, "Hey, Chairman Selig and I are going to work to get Hyperliquid onshore." And I think you have to say that a lot of the Hyperliquid move was idiosyncratic, related to that subject. Now, as these perp dexes are coming on shore, what can they do? Number one, they can follow the old way, which is get what I like to call the cocktail of derivatives licenses: DCO, FCM, DCM, or maybe the CFTC is going to be bold enough, and if anyone can do it, it's Chairman Selig, on finding ways to align with the principles of the regulation, disclosures, controls, etc., with the technology as it works. And I testified in Congress a bunch of years back saying, you know what, we don't really need intermediaries with this technology. You may want them, but you don't need them. Anyway, blah, 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 blah. So regarding this hearing, so you have Luana from Kalshi, you got Duffy from CME. And the first thing that I love about it is the visual. You can't get two more opposite people, right? Just look at them. And Terry is the CME has been a dominant factor. They're an incredible business. And lately their stock price has been taking a hit because of some of this disruption. And when you're an incumbent, you have to make a decision, and it's a tough decision. Do you try to fight? Do you try to fight? Do you try to put up regulatory gaps? Do you try to do whatever it is to keep the status quo where you're doing quite well, or do you swim with it and have partnerships? It looks like Chairman Duffy is looking to fight right now. He was very Terry was very critical of prediction markets, saying that they're prone to manipulation. Well, I've got news for you. It's illegal to manipulate derivatives markets. And to the extent somebody manipulates a derivatives market, the CFTC is going to hold them accountable. So guess what, guys? Don't do it. And the other thing is they'll immediately go and say, FTX this or FTX that. Let's just look at history. FTX blew up overseas. When we have a thoughtfully regulated market, which you want to see here, that's a good thing. And so, and then Luana's right. If she's able to accomplish these things with more automation, probably pretty awesome than rather have a lot of people manually going around checking things. So look, at the end of the day, what am I a fan of? I'm a fan of innovation. I'm a fan of markets that are not subject to manipulation. And to the extent there is fraud, manipulation, or abuse, let's get after him, Chairman Selig. And that's exactly what he's doing. And I'm a fan of automation. Automation is the way that we can scale. So let's accelerate these derivatives markets. ICE has been very thoughtful as well, and their embrace of the technology that did the deal with Polymarket. I think my personal sense is that Terry Duffy is probably he's probably not consensus right now. I'm seeing a lot of the other exchanges actually moving very fast to embrace prediction markets. Oh, last thing, guys, let's just remind each other: derivatives rule the world. Spot markets don't really matter that much. It's derivatives that rule everything. All right, I've said my piece.
I like to call this the pugilist and the ballerina. That's what I think yesterday's
right. It's just
meeting was all about, really, and it's all there in it, and you've got youth, elegance, right, and then you've got the kind of swaggering prize fighter looking to take back the title belt, and that dynamic is totally understandable. But I think it's going to be kind of grace and elegance, intelligence, suave panache, poise that ultimately wins here. But you said it right, Chris, about derivatives markets ruling the world. And speaking of fighting, not just CFTC fighting, if you want to see an instance for how these markets sometimes have, we'll call them inappropriate activity, such as the betting that happened around a conflict and kinetic outcomes in the Persian Gulf, those are actually quickly spotted, right? And people were slapped on the wrist, and I think are going to face significant penalties for placing wagers on things for which they had, kind of asymmetric and material non-public information. So while I'm not going to say that I see no point in the points that Duffy has made, I'm going for the ballerina, to take the belt home in this discussion.
I think Luana was a classic. She was a classically trained ballerina, by the way.
Oh, 100%. That's absolutely right.
I was going to say, it's not like there hasn't been manipulation in traditional derivatives markets.
Never.
So
Never.
LIBOR did not happen. Everybody memory hold that thing. It's not real. It's totally not the case that hedge funds have taken position in derivatives and then hammered thinly traded spot on people in the CDS market. Like, none of those things have ever happened. It's fine. It's fine. But like, all nonsense aside there, I was watching this, and it's interesting to me to see the fight being between Kalshi and the CME, because I want to take the opposite side. The dominant voice here, who should probably be determining this, is actually the customers, right? Because if we're thinking about what makes markets valuable, it's, can people use them for purposes that actually have utility? Are we hedging? Are we speculating? Are we raising funds? Like, are we engaging in things that ultimately lead to productivity? Because, I have an old economics professor who used to say, if you're not doing those things, it actually is gambling, right? But if those activities are at sort of the core of what your markets are doing, at least in some amount, then you have real capital markets. And I'm curious as to where this debate goes based on how people vote with their money and vote with their feet. Because the reality is the CEOs of like Kalshi and CME can say whatever they want, but you've still got to win the game to get the trading volumes and deliver the best product to people. And isn't that ultimately what we should be following? Like, Ram, for you, as an investor, when you see this fight breaking out, how are you thinking about this on a forward basis? Like, who's winning and who's losing here?
Well, on the one hand, having these prediction markets to price events, including election outcomes, is truly extraordinary. It's great to see that. On the other hand, like, of course, those markets are manipulated. Of course, it's a negative expected value for the consumer. And I don't think it's a healthy product for the vast majority of consumers. From an investor standpoint, the question is, can Kalshi translate in a boarding event like the World Cup and make that customer sticky and then adopt new categories? We'll see. That's hard to do. I'm not terribly excited about those businesses given where their valuations are. I think one of these businesses just doubled their valuation after the World Cup and is raising money. I look at that as, if you're an insider, you should be selling. I think that's probably, what some of these folks are doing. So on the one hand, excited about the innovation. I just don't think they're great products for consumers or investors.
How long, Ram, do you think you use prediction markets as part of like hedging strategies? And Gordon, are you guys doing that already?
It's great for getting information and insight from. That's how I would look at it. But, the best hedge for a risky asset is to sell the asset. That's the first thing you do.
Yeah, so I agree with Ram about using the information that you get from the markets today. That's what they're useful for, because we've got liquid, transparent, functional, scalable, linear and nonlinear derivatives markets. That's the space I play in. And that's where I think I find, positive expected value, consistent alpha, let's say across a volatility surface. And unless I'm thinking about running an ARB strategy, let's say between binary outcomes and prediction, space and vanilla options outcomes, which is not yet within my mandate. But, if I were back at Genesis running a regulated derivatives business, we probably would have had a healthy slice of that in the prop book. But looking forward, right, what are the products that could be healthy for the customer base? I got one for you. And if you're an executive at, Polymarket or Kalshi, call me up. We can talk about it. Parametric insurance, right? Why aren't these guys building in this space? Because that is a highly illiquid, opaque, and I would say unsubstantial marketplace that doesn't live on chain, doesn't have smart financial quants trying to solve the problem through DeFi, and is more or less trafficked by a bunch of parasitic brokers and large balance sheet players. The primitives that have been discovered through Polymarket and Kalshi tell us one thing: liquidity will aggregate around outcome projections. Whether those are fairly priced or not is a separate discussion. But when you look at the world today, and Chris, you and I in our little tete-a-tete had this discussion, you are all about making entropy great again. And I'm right there with you. And I think the way that we make mega happen is by creating mechanisms for decentralized financial risk mitigation that disintermediates a lot of the interstitial tissue, sclerotic interstitial tissue, I should mention, that is held back, financial innovation, and a derivatives market where you could, let's say, get parametric coverage for, I don't know, a Bolivian dam operator that's facing a perhaps existential drought, and he's not going to be able to get his favorite XYZ broker or underwriter to approach that, is a great thing, right? And other types of nat cats and other types of hard to categorize binary outcomes around which we can build oracles that are robust to manipulation. That's really interesting stuff. I do think also that, working with financial parameters as a start and not just event parameters, RWEs, is helpful because it starts to drive convergence, right? There can be manipulation, let's say, in things like, the 15-minute epochs on Bitcoin outcomes on a predictive marketplace. But guess what? Once they get liquid enough, the vanilla options and linear derivative guys are going to come in and try to arb it, and that's going to drive convergence in a salubrious way. And I think ultimately what I've kind of intoned about insurance potentially in a parametric fashion, living on chain or living on these types of markets may also ultimately be able to be cured in the same way. So it's neither all bad nor good, but for now, it's a great source of incremental useful information. It's a good conditional prior, right? And I think all of us on this call, in some way, shape, or form, we live in a Bayesian, intellectual and investing framework. And if you can give us another high alpha conditional prior, we'll take it. So thanks, Polymarket and Kalshi.
So I think I'll pile in though to say I think the parametric stuff is a severe dead end. As somebody who's probably traded maybe more ILS than almost anybody in the world over the past 2 decades, which is to say, you have two very severe problems in parametric markets as you think about building out that market that has caused them not to take off. Number one is your basis to what your actual exposure as an insurer is. On the front end of the contract, I owe people economic losses for things that have happened. On the back end of the contract, I have a parametric trigger, and all too often they move in the same direction, which puts me towards bankruptcy, not away from it. Like I will have missed on the parametric trigger and lost a shitload of money, or the storm will miss some location, but it'll have hit some parametric gate. So I kind of made money for no reason. It starts being a very weird thing. And this leads to a regulatory overhang where they don't give you full reinsurance credit for the parametric cover, which is why they don't want to buy it, right? If you look at the balance sheet of like an Allstate or a Prudential, if we want to think about life markets, they're trying to get as close to risk distribution as possible. That is to say, we do a bunch of business on the front end. We have to have some level of legal risk retention, but we want to offload as much of the rest out the back as cheaply as possible as we can. And if you look at Pru's balance sheet, by the way, they're offloading vastly more risk than they hold on to nowadays. And when you don't get full reserve credit for offloading through parametric markets, it's just incredibly inefficient. So the prices that you're willing to pay are nowhere near a market clearing price, so you just don't use it. Where I think parametrics are useful is more going to be, and Gordon, you may have alluded to this, like local disruption type events. I don't think it's going to be useful in insurance markets because this whole framing of like economic losses and exclusions and principal agent problems and fraud are really what drives all of that. And the parameter is like maybe number 8 on my list of things that I'm worried about there.
Yeah, it's a stopgap. I think you're right, and I think it actually speaks to the Terry Duffy and Luana problem, right? You've got pugilistic dinosaurs and very lithe, nimble ballerinas, and they each have their own view of the world. I think Terry Duffy would say that the regulatory framework to which he must uphold himself is the same as the one that the insurers would say, "Hey, look, parametric's a great idea. I can't use it because I don't get full offset." And the prediction market people would go, "That's because your regs suck. And I can't work with those. We're here to solve the future problems of finance." And that may be part of the gap that that those folks are trying to solve, both in the insurance space, but also trying to think of how you reconcile. And as you say, both cases, it's going to be the insureds who are seeking coverage, right? And in this case, of course, it's going to be the client, right? The directional position person who wants to come in and get that, and they're going to say, okay, maybe I like the products that appear on Terry Duffy's CME in various shapes or form, or maybe I really like Polymarket or Kalshi's, or maybe I pick and choose, and some are good for some risk mitigation situations and some are not. And I think as a portfolio manager, Chris, you probably could relate to that as well as anyone.
As you think of the utility of prediction markets, there's a few things to consider. Number one, the information can be invaluable if there's sufficient liquidity, and liquidity helps you with that. What the paradox of prediction markets is that they're these like micro mini markets, right? And oftentimes these micro mini markets, which is where the value is, there's just not enough liquidity, so it's hard to find truth. I do think you're going to eventually see pretty amazing markets form where you're betting on parts of the company, so then rather than just like reading an earnings statement and coming up with a recommendation buy or sell, if you're an analyst, you'll be able, and these markets are already forming, guys, like you'll be able to look at certain parts of like sales in the Southwest or number of phones units sold. You'll be able to bet on them and you'll get much closer to truth. Again, the values deriving from the data. Then, of course, any good derivatives markets, you have hedgers and you have speculators, and those are like defined terms. We're starting to see the emergence of some hedging. There's a classic story of the bar who's betting, for against the Knicks so that they can hedge the drinks that they're going to give everyone for free. That will start um, spreading, provided there's enough liquidity in the market that you can actually put on a hedge. And then the last thing is speculation. Speculation is a very important part of markets. For those of us who study them, it creates liquidity, and there's plenty of speculation to go around. And my daughter, who thinks that she's smarter than any market, will tell you that.
I want to get to a last item so that Ram has his chance to take the once per show mandated shot at Sam Altman.
Here we go.
Yep.
Nothing burger. Nothing burger.
Which is the 20-cent frontier model. So there was a mystery model released called Ox Alpha or 0x Alpha, depending on how you want to look at it, which appeared on Open Router. Quote, a frontier model built for efficient coding, sustained agentic work, and real-world production use. A lot of people have been speculating it's from ZAI and the GLM family of models. There are a couple of things that led to that potential conclusion within the architecture of the model. Some of the other models evaluating it were guessing that that was the case. But rather than talking just about the hunt, let's talk about something important here. This is the top open weight coding model. It scored a 28.3 on Terminal Bench 3.0. And by the way, Fable is 33.7, GPT 5.6 Sol is 34.6. So we're talking a pretty goddamn powerful model. And then it's going to be priced apparently at a 10th of the Frontier per token rates. Coin Bureau said a mysterious new AI model reportedly beating Claude Fable 5 and GPT 5.6 Sol at coding, and nobody knows who built it. They said, the model designers, we have the capacity for 100 trillion tokens per day, decent amount of compute. And Bloomberg is saying the US-China AI gap chart is getting obliterated, noting that Kimi K3 is also close to Fable and 70% cheaper per task. So, Ram, I want to lob this ball over to you first, because I know you've been thinking about AI economics for a while. What do you make of the speed at which open weight models are coming and the economics of them when they're getting this close to or better than the frontier models?
Yeah, capitalism and competition is wonderful. Consumers are mean. Small business adoption on ramps. Customers are now at 42% and growing. This is all wonderful news. I have a theory on who this could be, this model. NVIDIA, it was announced today, is investing $6 billion into a company which is America-based. It's called Poolside. They're investing at a $12 billion valuation. Sorry, they're investing $1 billion at a pre-money of a $12 billion valuation. So this could be a lean American open weight model. Maybe this article was timed with the release of that model on OpenRouter. That's my hypothesis. I was at Anthropic's headquarters last week visiting a friend who I called a member of technical staff. It's impressive what they're doing. I think their margins will come in better than most people think. When they drop their S1, I expect it'll be a market-defining event. People are going to look at, are they subsidizing users, or are their gross margins attractive without the need for subsidy? I think it'll be more of the latter. This is not a bubble. It's a real story. You're going to see continued investment. The question is, in the midterms, will politicians continue to press utility companies and press data center firms, or will that drive up data center cancellation rates, which would be very counterproductive for American progress?
Yeah, I think one, your point about the ultimate winner here being consumers is almost certainly correct. It's interesting to see with the AI build out how much of a parallel there has been so far to the original internet build out, which is to say we've gone through things like where is the value going to accrue, what companies are going to have these problems, who is developing these frontier solutions, and then rapidly destroying everything and trying again and destroying everything and trying again as we get better and better very quickly. I will remind everybody, almost nobody is still using Netscape or AOL, right? And yet at the time, those were paragons of the market in some ways. And so I think you're right that the ultimate value goes to consumers. What is very interesting to me here is that whether you're a, call it open weights or closed weights, like model person, and how you think about the economics there, the bottleneck is going to be compute and power. And those are structural areas, right? And we're seeing
100%.
a lot of pushback against that. Like Gordon and Chris, I'm curious what either the two of you are making of this sort of like schizophrenia in the market, of the market being very excited about the model companies while everybody is trying to kill every data center known to man.
Go ahead, Gordon.
Yeah, well, I was just going to say, look, I think Poolside is a great, speculative projection. Clearly, Jensen Huang was out in his first X post not long ago talking about the merits of open source, and people have trumpeted this. Open source has a great track record, but not always, the king of the hill. Linux, many people cite. Surely, as someone who, for my own econometric research and sort of quantitative insights, do sometimes use open source, open weight models. The stuff is great. I mean, what can you say? Monopolies oftentimes have a shelf life, and monopolies on LLMs, like we see out there, they look like monopoly type pricing. And so it stands to reason that, at least in some use cases, the king of the hill may be dethroned. But the big picture, as you say, is consumer wins on token pricing, most likely, at least in the short term. But the big picture, long term, is power, right? I mean, it's really kind of the binding constraint of human productivity expansion. And I often ask this question tongue in cheek, which is to say, is the compute industry and data center industry going to look like the Bitcoin mining industry? Because when I was at Genesis making markets and trying to convince miners in 2021 and 2022 to collar their production, and they're telling me that they had 3 or 4 cent power from now until the end of time, I usually just laughed. And I think, the question now is, how viable is the massive buildup of North American compute going to really be? Or if you are a frontiersman, should you be calling up Serdar Berdimuhamedov in the independent, free, unaligned Republic of Turkmenistan, who will sell you power at 1 cent from now until as long as he shall live, May he live 100 years from now. And is that a place that you should really be thinking about diversifying compute? I don't know, because I'm not in that business, but I do look at the paradigm of guys who swore up and down that North America was an economically viable place for Bitcoin mining. And then it was economically viable as long as you had an ERCOT contract. And then it was, well, it's economically viable because it can fund data center business. It runs at much higher and more distributionally stable IRRs and ROIs. I think that these are questions that are going to need to be asked. Just where do you source the power for your compute? And is the political establishment going to permit that? And therefore, the question I always like to ask is, how do you hedge that? And that's probably a subject for another podcast.
Prediction markets. Look, it's really, really, it's very rare that Republicans and Democrats agree on things. And when you're starting to see them beginning to agree on that data centers are going to be a major issue as we go into the elections, and it seems to be that they're starting to align a little bit. That's not good news for the AI industry. And the good news is I think they started to wake up and they realized that they're going to have to really work on their narrative. They're going to really have to work on explaining the value that they're here to bring through these data centers. The whole NIMBY discussion is very much in effect. But believe you me, this is going to be a defining election for the AI industry. And I really, really hope that they are able to tell a better story about the utility that they're bringing. And to the extent where they've gone, too far, and the data centers are maybe not built in a way that you want them in your backyard, maybe they need to adjust their approach. But I think that the entire industry is going to be under increased political pressure. But as crypto people, we know what that's like, guys. So maybe we can give them a couple of ideas.
I mean, to some extent, if you look at sort of the grab bag of reasons people have for opposing AI, most of them are factually incorrect about data centers. Like the water usage arguments are just wrong. Some of the job arguments are just wrong. I think what we really have here is just a factual, narrative structure problem for the data centers, because let's be totally honest, nobody trusts big tech, right? Especially when the pitch of a lot of the AI companies has been, we're going to destroy all your jobs. And then as a side effect, our machine god is going to rule over your society, but totally trust us, this is fine. It's not surprising to me that a lot of people are like, we don't want these things around.
I'll challenge you.
Tell me.
People don't like social media. People like Amazon. They like usage of their Google services, which they get for free. They consume Netflix. They enjoy their Tesla. So Americans do like technology. The issue is the leadership of these frontier lab models are scaremongering Americans about mass employment. The perception of AI in China has an 85% favorable rating. In the US, it's 35%. Now, we've only seen the criticism of the AI data center. So it's just utilities, there's utility, sewage systems utility. No one complains about NIMBY when is upgrading the sewage in the backyard. The utility, intelligence on demand, is utility. All these utilities confer benefits. It's not going to be hard for people to combat these once you're in the election debate. You talk about the daughter who is cured of a disease or cancer. You see these innovations, and again, a small business using this, so they're going to see through this. I don't think it's a winning argument. I think it's actually a very weak argument. And to the earlier point, you've got firms like Andreessen Horowitz spending $200 million in PACs, pro AI PACs. That rocks fair shake, by the way, in the last election. A lot of this criticism against AI and the wealth tax is actually a political move, because they've seen Silicon Valley lean right. And so they're trying to attack that at the knees. Let's do a wealth tax. Let's control AI, because they want to preserve political power.
So I will say, I think, having been in a meeting or two just to see what these are like, I agree with you. People hate social media. They hate AI. I think some of them just don't have trust with the big tech companies, because I'll counter you on Google. I've had a lot of people criticize them for surveillance, Rom. I do think it's a trust issue on all these things. I also think it's, to some extent, like a revenge of the nerds kind of thing, by which I mean you've hollowed out rural communities, you've been unrepentant about it, you don't understand the human cost, and you've just acted like everything's a number in a spreadsheet, it's not surprising to me people are pissed with you and just kind of want to poke you in the eye with the stick. But I think we need to figure it out, because to channel Chris here before we have to go, there are national security implications to this as well. And I think it's important that the US has these capabilities. So since we're out of time, I'll say thanks again for joining us for this episode of Bits and Bips. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, everyone, thank you for watching, and hope you enjoyed this episode of Bits and Bips. Just remember, nothing we say here is investment advice, and please check unchainedcrypto.com/bitsandbips for more disclosures.